The British housing market isn't crashing equally everywhere, and what's happening right now is creating a dramatic divide between those making fortunes and those watching their wealth evaporate. While headlines scream about falling prices, the truth is far more complex, and understanding which side of this split you're on could determine your financial future for decades to come. Right now, in January 2025, we're witnessing something unprecedented. Certain postcodes are seeing property values climb while neighbouring areas tank. This isn't random chaos, it's a calculated reshuffling of wealth across the nation, and the pattern emerging reveals exactly who the winners and losers will be when the dust settles. The data coming through is painting a picture that most Brits simply aren't prepared for. London properties under $500,000 are suddenly hot commodities again. Buyers who couldn't get a look in 2 years ago are now snapping up flats in zones 3 and 4 like there's no tomorrow. Meanwhile, luxury apartments in prime central locations are sitting empty, with sellers slashing, asking prices by hundreds of thousands just to generate interest. The reversal is so stark that estate agents in Kensington are reporting their quietest January in 15 years, while their colleagues in Lewisham can't keep up with viewings. If you want to stay ahead of what's really happening in UK property and the economy, smash that like button and subscribe to Property Reporter, because we're bringing you the facts that others won't cover. The north-south divide everyone talks about has completely flipped on its head. Manchester and Liverpool are experiencing price growth that London hasn't seen since before the pandemic. Properties in Greater Manchester increased by an average of 4.2% in the last quarter alone, while Greater London saw a decline of 1.8% over the same period. This represents a fundamental shift in how people value location, and it's rewriting the rules that governed British property for generations. Northern cities aren't just holding steady, they're actively pulling investment away from traditional southern strongholds. Birmingham has recorded its strongest quarter for new buyer registrations since records began in 1998. Newcastle property viewings are up 67% year-on-year. Leeds has seen a 39% increase in mortgage approvals compared to last January. These aren't marginal gains. These are the numbers you see when money is flooding into a market. What's driving this isn't just affordability, although that plays a role. The remote work revolution that everyone said would fade away has actually become permanent for millions of workers. Companies that insisted on full-time office returns in 2022 and 2023 have quietly reversed course as they realised they were losing talent to competitors offering flexibility. This means a London salary can now be earned from a Manchester home, and suddenly that 3-bedroom terrace in Salford offers better value than a cramped 1-bed flat in Stratford. But location isn't the only dividing line. Property type is creating winners and losers within the same streets. Homes with 3 or more bedrooms are selling at premiums, while 1- and 2-bedroom flats are being discounted heavily. In Bristol, a 3-bed semi-detached house sells within 2 weeks on average, while a 2-bed apartment in the same neighbourhood sits on the market for 4 months. Families are the hot buyers right now, and they're dictating terms. The build-to-rent sector exploded over the past 5 years, but those investors are now facing a reckoning. Purpose-built rental apartments in city centres that were supposed to be goldmines are struggling with vacancy rates climbing to levels not seen since the financial crisis. In some Manchester developments, 20% of units are empty. Birmingham's Broad Street area has so many vacant rental apartments that landlords are offering 2 months free rent just to get tenants through the door. The institutional investors who poured billions into these projects are quietly exploring exit strategies. Meanwhile, small-scale landlords with traditional houses in suburban areas are doing better than they have in years. Rental demand for family homes with gardens and parking has never been higher. Tenants are staying longer, paying on time, and competition for these properties means landlords can be selective. The average rental yield on a 3-bedroom house in a commuter town is now outperforming city centre apartments by almost 2 percentage points. That gap represents the difference between profit and loss for many investors. Interest rates are the elephant in every property conversation, but their impact isn't uniform. Homeowners who locked in fixed-rate mortgages at 2% or below before the Bank of England's hiking cycle began are living in a completely different reality than those coming off fixes now. Someone with £200,000 outstanding on their mortgage is facing an extra £700 per month when they remortgage from a 2% fix to a 5% variable rate. That's £8,400 a year in extra housing costs with no additional benefit. This rate shock is forcing sales that wouldn't otherwise happen. Properties hitting the market with wording like chain-free and price reduced are increasingly from owners who simply cannot afford their new mortgage payment. These aren't distressed sales in the traditional sense. These are middle-class families who did everything right but got caught in a policy shift they couldn't predict. Their loss is creating opportunities for cash buyers and those with smaller mortgages who can negotiate hard. First-time buyers have been declared extinct so many times it's become a running joke, but right now a specific subset of them is thriving. Young buyers with hefty deposits saved, often with family help, are finding that reduced competition from mortgaged buyers gives them negotiating power that didn't exist 2 years ago. Sellers who previously would have had multiple offers are now grateful for one serious buyer, and that buyer can chip away at asking prices. In some areas, first-time buyers are achieving discounts of 10 to 15% below the original listing price. However, first-time buyers dependent on high loan-to-value mortgages are stuck in limbo. The 95% mortgage products that were supposed to help them onto the ladder come with interest rates so punitive that monthly payments rival rental costs without building meaningful equity. A 95% mortgage on a £200,000 property at 6% interest means paying approximately £1,200 monthly, with only about £300 of that reducing the actual loan in the first year. The math simply doesn't work for many. The build quality scandal unfolding across New developments is creating another dividing line. Properties built between 2015 and 2022 are increasingly being identified as having serious defects ranging from fire safety issues to structural problems. Owners of these homes are finding them unmortgageable, which means unsellable. Entire apartment blocks in cities like Leeds and Manchester are effectively worthless on paper because lenders won't touch them until remediation work is completed, and that work is stuck in legal battles over who pays. This has created a two-tier system even within new builds. Developments from established builders with good track records hold value, while anything from builders who've since gone bust or been acquired is viewed with suspicion. Buyers are now hiring independent surveyors even on new properties and walking away when issues emerge. The developers who cut corners to maximise profit during the building boom are being exposed, and their customers are paying the price. Energy efficiency is no longer a nice-to-have, it's a value determinant. Properties with EPC ratings of C or above are commanding premiums, while those rated E or below are being discounted because buyers know they face mandatory upgrade costs coming down the pipeline. The government keeps pushing back deadlines for rental property EPC requirements, but the direction of travel is clear and buyers are pricing in those future costs now. A Victorian terrace that would have sold for $300,000 2 years ago now struggles to hit $270,000 if it's rated E, because the new owner knows they need to spend $30,000 on insulation, windows, and heating systems. Landlords with poorly rated properties face the harshest reality. They can't sell without taking a significant loss, and they can't rent without expensive upgrades that won't pay back for years. Many are simply exiting the market entirely, selling at whatever price they can get, and moving their money elsewhere. This forced exit is reducing rental supply in some areas, which pushes rents higher, which makes the rental market even more attractive for landlords with efficient properties. The gap between good and bad landlord investments has never been wider. Scotland and Wales are experiencing their own unique dynamics that diverge from England. Scotland's house prices have remained remarkably stable compared to the volatility down south, with Edinburgh and Glasgow showing modest but consistent growth. The Scottish market moves more slowly generally, but that stability is now attracting investors tired of the rollercoaster in England. Wales, meanwhile, is seeing a tale of two markets, with coastal areas still riding high on post-pandemic migration, while former industrial towns continue struggling with minimal price movement and high days on market. Northern Ireland is the forgotten corner of UK property discussions, but it's quietly outperforming. Belfast property prices are up year on year, even as London falls. The combination of relatively low prices compared to the rest of the UK, improving infrastructure, and a growing tech sector is driving demand that the market hasn't seen since before the financial crisis. Buyers priced out of Dublin are increasingly looking across the border and finding properties that would cost £1 million in the Irish capital available for £300,000 in Belfast suburbs. The commercial to residential conversion wave that was supposed to solve the housing crisis has created pockets of terrible housing in stock. Former office buildings turned into tiny apartments with no outdoor space, and minimal natural light are proving almost impossible to resell. Buyers who purchased these conversions off-plan, thinking they were getting a deal, now find themselves owning properties nobody wants. The resale values on some of these conversions have dropped 40% from the original purchase price, and they continue falling. Conversely, high-quality barn conversions and period property renovations are holding value exceptionally well. Buyers with serious money want character and space, and they're willing to pay for it. A well-converted barn in the Cotswolds or a tastefully renovated Georgian townhouse in Bath can still command premium prices and sell quickly. The flight to quality is real, and it's separating the property market into distinct tiers that barely interact with each other anymore. Leasehold properties are becoming increasingly toxic, especially flats with short leases or high ground rents. The leasehold scandal has been bubbling for years, but it's now seriously impacting values. Properties with less than 80 years on the lease are being avoided by buyers who understand the extension costs involved. Ground rents that escalate significantly are red flags that kill sales immediately. The government has promised reform, but until legislation actually passes, buyers are treating leasehold as a serious negative that requires substantial price discount to compensate. New build estates on the edges of cities promised community and convenience, but many are turning into ghettos of negative equity. These estates often lack proper infrastructure, with promised schools and transport links delayed or cancelled entirely. Residents find themselves miles from amenities with inadequate bus services and rising car dependency. When they try to sell, they discover their homes are worth less than they paid because nobody wants to make the same mistake. Some of these estates have average property values 15% below purchase prices from just 3 years ago. The really interesting pattern emerging is geographic clustering of price performance. It's not as simple as north versus south anymore. Instead, specific towns and even specific neighbourhoods are hot, while areas 10 miles away are cold. Proximity to good schools, train stations with direct links to major cities, and local employment hubs creates micro-markets that perform completely differently from their surroundings. A house in Hitchin holds value while nearby Stevenage struggles despite similar prices, and both being in Hertfordshire. Understanding these micro-markets is becoming essential. Blanket statements about regions are increasingly meaningless. You need to drill down to the town level and even neighbourhood level to understand what's really happening. Two streets in the same town can show completely different price trends based on factors like school catchment areas, flood risk, crime statistics, and even which direction properties face. The data is available, but most buyers aren't looking at it closely enough. Auction sales are spiking, which is always a warning sign. When properties can't sell through traditional estate agents, they end up at auction, often at significant discounts. Auction volumes are up 32% compared to last year, and success rates are declining, meaning even at auction, some properties can't find buyers at any price. The properties going to auction aren't just the obvious problem cases anymore. Increasingly, ordinary homes in ordinary areas are being auctioned because vendors need to sell, and the traditional market isn't delivering. Cash buyers are absolutely dominating right now. With roughly 1/3 of all transactions now cash purchases compared to 1/4 pre-pandemic, having access to cash or substantial equity gives buyers enormous advantages. They can move faster, negotiate harder, and aren't subject to mortgage approval uncertainty. Sellers actively prefer cash buyers even at slightly lower offers because completion is far more certain. This is exacerbating wealth inequality, as those with capital can accumulate assets while those dependent on borrowing face mounting barriers. The generation gap in property ownership is now unbridgeable through normal means. Millennials and Gen Z without family wealth are looking at a future where home ownership is simply unattainable regardless of their income or savings discipline. The math doesn't work when house price to income ratios sit at 8-1 nationally and higher in desirable areas. Meanwhile, older generations who bought when ratios were 3 or 4-1 have accumulated wealth through property appreciation that younger people cannot replicate. This isn't a temporary imbalance. It's a permanent restructuring of who gets to own property. Inheritance is becoming the primary route to home ownership for many young people. The Bank of Mum and Dad is now the 9th largest mortgage lender in the UK by volume, which is both impressive and depressing. Those without access to family money are competing in a completely different market with completely different rules. This creates an emerging class system based not on earnings or education, but purely on whether your parents or grandparents own property they can borrow against or gift from. The really uncomfortable truth nobody wants to say out loud is that the UK housing market needs lower prices, but politically cannot allow them to fall significantly. Too many voters have too much wealth tied up in property values, and no government can survive a crash that destroys middle-class nest eggs. So instead, we get managed decline through inflation, where house prices stagnate in nominal terms, but fall in real inflation-adjusted terms. Your house might still be worth $300,000 in 5 years, but that $300,000 will buy much less. This managed decline approach creates the current split market. Areas with genuine demand fundamentals hold value or even grow in nominal terms. Areas without those fundamentals decline slowly rather than crash. The result is a grinding revaluation that takes years rather than a quick shock correction. It's less dramatic than a crash, but the end result is the same: a significant repricing of property across the UK, with winners and losers determined by where you own and what type of property you hold. Looking ahead, the next 12 months will likely cement these trends rather than reverse them. Interest rates might come down slightly, but not to the ultra-low levels that fueled the post-pandemic boom. Mortgage availability will remain tight, with lenders demanding larger deposits and applying stricter affordability tests. The days of easy money are over, and they're not coming back anytime soon. This means the market reset we're experiencing is structural, not cyclical. Properties in the winners category, family homes in strong locations, with good transport links and schools, will likely maintain or slightly increase value. Properties in the losers category, small city centre flats with cladding issues or leasehold complications, will continue declining or stagnating. The middle market will grind sideways, with individual results varying massively based on specific circumstances. Predicting your local market requires a local knowledge and careful analysis of the factors that actually drive demand in your area. The UK housing market split isn't a temporary phenomenon caused by short-term economic conditions. It's a fundamental restructuring based on changed preferences, remote work realities, demographic shifts, and the unwinding of a decade-plus credit boom. Understanding which side of the split you're on matters enormously, because the gap between winners and losers will only widen from here. Those positioned correctly will build wealth. Those caught on the wrong side will watch opportunities slip away while they struggle with unmortgageable or unsellable properties that trap their capital. The exposed truth is that UK property is no longer a guaranteed path to wealth for everyone. It's now a selective opportunity that rewards those who understand the new rules and punishes those still playing by the old ones.